During the 2024 campaign, older Americans were given a blunt and memorable pledge. Every dollar of your Social Security benefits would be fully yours, completely free from federal income tax. But when the One Big Beautiful Bill Act was signed into law in July 2025, that provision didn't make the cut. Millions of retirees are filing their taxes right now expecting a massive windfall, only to find the door slammed shut. By the end of this video, you will know exactly what the new law actually gives you, how to calculate your true cash savings, and the hidden catch that almost no one is talking about. Instead of ending the tax on Social Security, Congress wrote in a brand new tax break nicknamed the Senior Bonus Deduction. There is a massive difference between the two. An exemption puts a shield over your money, so the IRS can't touch it at all. A deduction just slightly shrinks the pile of money the government gets to tax before they take their slice. Because they went with a deduction, the government didn't automatically give you a raise. They handed you a math problem. Here are the baseline numbers. The new law offers an additional deduction of up to $6,000 per qualifying person, or $12,000 for a married couple. To get it, you have to hit a strict deadline. You must be exactly 65 years old by December 31st of the tax year you are filing for. Let's look at James. James turned 65 on January 1st. He misses the cutoff by a single day. Missing that December 31st deadline means James loses the entire deduction for that prior year. The IRS offers no partial credit. If you do make the cutoff, you get to use a mechanic called stacking. Normally, taxpayers choose between a standard flat rate deduction or itemizing their individual receipts. This new bonus works for both, meaning you can stack it right on top of what you already claim. Here's how the stack builds for a single retiree. Start with the baseline standard deduction of $16,100. Add the existing $2,050 senior deduction. Finally, stack the new $6,000 bonus, bringing your total tax-free shelter to over $24,000. By stacking these deductions, you create the highest tax-free income floor in American history, provided you clear the bureaucratic hurdles. But there is a catch to securing that maximum payout. Your benefit is strictly limited by your Modified Adjusted Gross Income, or MAGI. That is simply your total income for the year, including the taxable portion of your Social Security, before any deductions are subtracted. To get the full deduction, your MAGI has to stay under $75,000 if you file single, or under $150,000 if you file jointly. Take Frank and Dot, a married couple living on a combined $90,000 a year. Because their income is well under the $150,000 joint limit, they easily secure the full $12,000 deduction. Now look at Robert. He is a single 66-year-old with an income of $100,000. He crosses the $75,000 single limit. Robert hits what the IRS calls a phase-out. For every dollar over that limit, the government claws back 6 cents of his bonus. Being $25,000 over the line means a $1,500 penalty. His final deduction locks in at $4,500, not the advertised $6,000. The math is designed to aggressively erode the benefit for any senior who managed to build a slightly more comfortable retirement. That brings us to the harshest reality of the new law. Getting a $6,000 deduction does not mean the government hands you a $6,000 check. Consider Margaret, a 68-year-old widow living on $32,000 a year. She meets the age requirement and falls well below the income limit, so she qualifies for the full $6,000 bonus. To find out what that's actually worth, we have to look at her tax bracket. A tax bracket is simply the percentage the government takes from your top dollars. Margaret sits in the 12% bracket. When we multiply her $6,000 deduction by her 12% tax rate, we see her actual cash savings. Margaret keeps an extra $720 a year, which breaks down to about $60 a month. The law successfully shrank her taxable income on paper, but delivered a mere fraction of the advertised $6,000 into her actual bank account. For the lowest income retirees, the math is even less forgiving. Take Eleanor, a 74-year-old living entirely on $19,000 of Social Security. Unfortunately, Eleanor falls into the zero liability catch. She already owes zero federal tax. Because you cannot reduce a tax bill that is already zero, this new deduction gives her absolutely nothing. And despite the political rhetoric, The long-standing formula that dictates how Social Security itself is taxed was completely untouched. The rule that subjects up to 85% of your benefits to taxation based on your combined income is still on the books. To make matters worse, this entire bonus deduction comes with a sunset clause. It is temporary, applying only to tax years 2025 through 2028 before it expires. To claim this relief while it lasts, you need to be precise. Ensure your birth date is entered correctly on your return, as that triggers the system, and look for the new IRS Schedule 1A to file alongside your standard 1040 form. When it comes to the tax code, reading the fine print is essential. If you found this breakdown helpful, like this video and subscribe to Easynance to ensure you stay protected and informed.